When large jobs require moving massive amounts of snow, get the work done quickly and efficiently with the Western Pile Driver and all-new Pile Driver XL pusher plows, both featuring Trace Edge technology. These pushers scrape down to the pavement with an advanced cutting-edge system that has independent 2-foot sections that move vertically, oscillate, and trip. Get more jobs done faster with the Western Pile Driver lineup of pusher plows.
Mike Bott from Frost Solutions, one of the owners of the company. What we do is provide a mini weather station to give you a tailored forecast to those particular locations so you know where and when and what to do in those parts of town. You know there's 2 or 3 or 4 or 5 different ways that people can experience tremendous value having a technology like this.
Welcome to the Entrepreneurial Journey with your host, Dave Westcott. The Entrepreneurial Journey is a weekly podcast that streams live every Tuesday at 9:15 a.m. Pacific on Dave's YouTube channel and LinkedIn profile. Now here's Dave with this week's episode.
Good morning and welcome to the Entrepreneurial Journey. I'm your host, Dave Westcott, and I have with me this morning special guest Jason Kono, co-founder and principal of Pilot Capital. Jason, good morning.
Morning. How are you doing?
You know, I'm doing outstanding today.
Love it.
I see you got some samurai swords behind you.
Yeah, they're from Japan. I don't know if they're official, but I lived in Japan for 2nd and 3rd grade, so
really
pretty cool. Yeah, pretty cool to get those in. My dad bought them for me. 2nd
and 3rd grade, and you've had them all these years.
Yeah, they're kind of a prized possession.
Wow. So in 2nd or 3rd grade, you're like, that's like what, 7, 8 years old?
Yeah.
It's got to be in that. It's got to be that age group, right? About 7 to 8.
Yeah.
Huh.
Yeah. My dad worked for Boeing, so we were overseas a little bit.
Overseas a little bit with Boeing. You got some samurai swords, and you've kept them for 40 some years, and or 35 years, 30 some years. All right, we won't make it worse than it is.
43 minus 8. Yeah, 35. Let's say.
All right, 35. You've kept them. You know, I always wonder. I was actually wondering this the other day because I've got a daughter who's 9. She's going to be 10. I've got a son who's 8, going to be 9. And I was wondering, in my head, I was trying to think of things that I kept as, a youth. I was really trying to think of, do I have anything from my childhood that when I was about that age that I kept and I held on to? And I was able to lock it down to one thing. I have a Boston Bruins hat that I got when I was about 10 years old. Okay. And so I was thinking if I give them a pocket knife, because I got these cool pocket knives from the John Wayne Foundation that are made by this company, Boland. And I was thinking, I wonder if I give them this, if they're going to lose it or if they would keep it. And it seems that you were able to retain the swords.
Yeah, they're big enough I couldn't lose them like a pocket knife. Couldn't take them to friends' houses. But, I had a pocket knife. I got, maybe 10 that I kept forever. Swiss Army knife. So I think a pocket knife could be great.
Okay, it can happen. So over two decades of experience in commercial real estate, and you've transacted over $1 billion in acquisitions and dispositions as a broker.
Yep.
Wow, that just has an impressive ring to it.
It sounds good. I kind of wanted to get to $1 billion before I got out of brokerage, which was the end of 2023. So yeah, it was it was a long journey. And that was a lot of transactions because, to be honest, some guys come in and they're selling $20, $30 million deals. I came in and I was selling, $1 to $10 million deals for the longest time. And, probably took a decade before I sold the deal that was more than 10 million. But yeah, got a lot of experience and, was very cool to see kind of firsthand impact that owning apartment buildings had, for these owners. I'd call them mom and pop owners initially. They own a 10 unit or they own a 20 unit. But then as prices went up, maybe a 20 unit would be $6 million, $8 million, depending on the neighborhood. And,
sure.
Then from there started selling larger buildings, 30, 50, that sort of thing.
Wow. So that's really where you cut your teeth.
That's where I cut my teeth. Yeah.
Yeah, that's exciting stuff. I mean, a lot of people get into real estate because they think they're going to make their fortune in real estate, and real estate is a tough market.
Yeah.
It's a
Yeah.
tough job.
It's funny. I was always interested in it, but growing up, the concept of commercial real estate or apartment buildings was never really on my radar. I just thought that you buy and flip houses, right? And so then I had a friend I had worked with previously that got a job as a commercial real estate broker. He's like, you got a sales background. I think you'd love this. And I kind of asked him a lot about it, and then ended up applying for the company he was working at. That was back in 2004. And so kind of got me on my journey into real estate and really learning the investment and commercial side of it.
Wow, that's cool. And so that experience leads you to start Pilot Capital.
Correct. Yeah.
And what does Pilot Capital do today?
Yeah. It was a long journey. And I guess kind of backing up, I was fortunate enough to have a mentor who, as a broker, really encouraged his brokers to own and invest in apartment buildings. I think what's unique about that is a lot of big brokerages, whether it's CBRE, JLL, Colliers, they don't really want their brokers owning real estate. They see it as a conflict of interest. And they just want their guys selling deals and doing that sort of thing. But this mentor was like, brokerage is great. You're going to make good money, but the way you build wealth is owning real estate. And so in 2008, I would have been, I guess, 26. My business partner and I, with this mentor kind of coaching us, found a small 9-unit on Queen Anne in Seattle, bought it. And, we had a whole plan to renovate it. We didn't have a lot of money at the time. We had, maybe $100,000 each, and we needed about 700. And so we had to go raise the rest of it and kind of hit up friends and family and our sphere of influence and bought the deal. And that kind of got us started into what we call syndicating real estate. So finding deals, raising capital, and then we'd acquire them. We'd be the general partner and run the renovations. That got us into property management. So that was in 2008. And we kind of did that for almost 10 years, just as, a couple brokers, no brand. We were brokers first, and then buying these deals, tried to do like a deal a year on the side.
Yep.
And then finally, we probably started talking about it 2 years, 3 years before we pulled the trigger. But finally, we decided we need to start our own company and really have a brand. And at that time, I think we managed about 200 units. We'd probably bought, 6 or 7 deals. And so 2017, we started Pilot. And at the time, we were doing brokerage, property management, and then syndicated investments. And so that really kind of started the company. We were always entrepreneurial before because we were 1099s, commission only. But that was really the real company where we had a brand that we owned and, employees that were ours versus just being a 1099 in another company. And so it's been, it's been a journey. I guess it's called the entrepreneurial journey. It's been a journey since then, but very fulfilling. And we've gone from, I guess at that time, 7 or 8 deals to now I think we've done 18 or 19. We also manage a pretty decent sized portfolio of apartment buildings, which is a lot of third-party clients. Those were our brokerage clients who we'd sell them a building, or maybe they do a 1031 and get into a larger property. And they'd say, hey, I used to manage my 15 unit, but I don't want to manage my 30 unit. Can you guys manage it for us? And so we started a management company. And so now that has, 25 employees. So we do the management and the syndications. And then at the end of 2023, I left the brokerage side of the business just to focus on raising money and looking for deals to buy, because we're kind of at a turning point in the market, that started when interest rates started going up. And so we started to see values go down. There was a bunch of new supply coming on that, caused rents to kind of remain flat or go down. And so, a lot of people are talking about a recession, maybe in the future. We've kind of been in commercial real estate in a recession for, almost 3 years now. And so
Wow.
I took that as an opportunity to go out and just focus 100% of my time on the investment side and no longer working with sellers and buyers of apartment buildings.
I love it.
Yeah.
You've said a couple of things I want to focus on. So I got to imagine in '08, 700K, a 9 unit, like that feels like a great deal.
Yeah, it was.
I mean, that's, like if you're looking for a deal like that today, what is that deal now? 2 million, 2.5 million? Capitol
Yeah. So
Hill?
that Queen Anne is probably now,
Queen Anne,
three to 350 a unit. Yeah, so you're probably closer to like $3 million.
Wow.
And we did buy it. I think our purchase price was about $1.25 million, but the equity we needed was 700. So
Okay.
we needed, call it 200 for renovations, and we put down 500,000 on, $1.25 million. So,
Yep.
a little bit over 40% down payment, I guess. And then money for reserves and renovations. And so, yeah, but it was a great deal. I remember when I got in the business, you could buy buildings for maybe 150,000 a unit in the best neighborhoods, Capitol Hill, Queen Anne. And I remember talking to guys as a broker, I'd be cold calling. They'd say, well, I'm going to wait till prices get back down to 125. And they thought everything in 2000 and, 6, 7 was too expensive. And I used to buy buildings for 100,000 a unit. And, then at that time they were 150 a unit. Now I look back almost 20 years and, I guess it is 20 years and buildings have doubled. So they went from 150 to 300, sometimes 400,000 a unit. Definitely depends on the vintage. The brand new stuff might be 500 or more a unit, but kind of that, the older stuff is in that, 250 to 350 a unit. Pretty wild.
It's still a great investment. I mean, you put your money in, and then somebody else is making your mortgage payment. They're taking care of your taxes, your costs, and now you're just doubling your revenue.
Yeah.
Right? You're just holding the asset.
Yep. You get cash flow too.
You get cash flow. So for any entrepreneur out there, like I think what you said was investing in real estate is how you build wealth. I think it's a great way to build wealth. I love the tip that you kind of threw in there was, hey, we just started trying to do a deal a year on the side.
Yeah.
And we did enough deals on the side until we said, hey, let's go and get our own thing going.
Yeah.
That's pretty cool. I love that. You also touched on a mentor, like having a mentor, talking to a mentor, working through a deal with a mentor. How important is having a mentor in your business for anybody starting out? Is that something that you would recommend to everybody, or is that?
Absolutely. I mean, I think it's, a lot of times mentors come in different, shapes and sizes, right? Sometimes it's official, sometimes it's not official. I don't think that this, gentleman ever said, hey, I'm going to be your mentor, but, he was one of the owners of the brokerage that we went to work for. And we specifically went to work there because, a couple of these guys were kind of, the godfathers of syndicating apartment buildings in Seattle. And, I think they were probably doing it, in the 90s, maybe even the 80s. Before it was such an in vogue thing. It's become very popular, kind of like around 2015 to 2017, and but they were doing it back in the 90s, and so definitely, I think we probably would not have been able to figure it out on our own. I think we probably would have been scared to kind of attempt it on our own, and so that first one he didn't participate, but he coached us. But actually, the second deal we did. There was 2 mentors actually, and they both helped us on that one because we had found our first deal in the first part of 2008 and then found another deal in the second part of 2008. And so we weren't super confident that we could raise the money we needed for the second deal after raising the money for the first deal, which was a lot harder than we thought. We thought we'd go out and get, 500 grand from 5 people, 100,000 a piece. And it ended up being, I think we had 17 investors in there.
Wow.
And so, and I get it now. People are a little bit apprehensive to invest with a couple, young guys buying their first building. And so instead of getting people, at 100 grand, we got people at 25 or 50,000. But what's been great is a lot of those first 17 investors still invest with us today. And a lot of our referrals and new investors come from, people they've referred us to. So it was actually, I think in hindsight, really good. We ended up with 17 investors and not just 5 investors in that deal like we thought it would be.
How do you pitch an investor?
Yeah, we've definitely have gotten better. I think that I laugh at like I still have the PDF of the original deck we put together back then, which was pretty small and not very sufficient for people to make a good investment decision. But really, it's a lot of it has been relationship building. A lot of it is people that know we've been in real estate for 2 decades. Initially, also it was clients that already own apartment buildings, and so they would maybe at the time if they want to buy 10 units, $1.5 million, and they need 500 grand, but they didn't have 500 grand, and so if we were raising money for a deal, they'd throw us 50 or 100, and so that was kind of how we got the investors initially, and then from there it's been a lot of word of mouth. We have, I think, about 125, maybe 150 investors now throughout our deals. A lot of them invested in multiple deals. We have a couple that have invested in almost every single deal we've done. And of course, those are the ones that, oftentimes are the best source of referrals and tell their friends about us and kind of the success they've had with us. And so, but we went from just kind of a deck and we'd meet people to, sending out emails and kind of doing, we do a newsletter where we educate investors and potential investors. We have about 900 people on that email distribution list that are potential investors. So it's educating them. It's educating them what it's like to invest in a direct real estate investment with a group like ours. And then really it's just, you got to be good and not lose anybody's money and have success. And then it just kind of goes from there. And so, it went from being hard to raise 3 to 5 million to, getting to the point where maybe if we're raising 4 million, we have to limit people. Some guy might say, I want 500 or I want 750, but we're trying to get other investors in. And so, it's always kind of like, where's that point where could we raise 15 million for one deal? That might be a little bit tough, but we could probably raise 10. So, yeah.
So how does a deal work? You like, as an investor, why would I why would I put my money, into a syndicated real estate deal versus putting it into the stock market?
Yeah, great question. I think that what we found with our investors, and not every investor is like this, but a lot of them are highly weighted in the stock market. I think that for a long time, bonds had no real return. And so, for people that maybe have 90% of their wealth in the stock market, they would say, I don't feel comfortable with this. I want to have, more in real estate. And real estate has been a great asset class. And, I think particularly housing, I think will always be a great asset class. And so, our typical investor is, we have a lot of entrepreneurs, a lot of tech guys, and, also the entrepreneurs, they may have a lot of their net worth in their own business. And so they want to diversify into real estate. I think that the common theme for people that invest with us is that they're very busy, and they don't want to take the time or have the experience or knowledge to do this on their own. So you have always people that go out there, as a broker, you have people that maybe they get together 500,000 or $1 million, they go buy their own building. But then what I realized was for every person that can pull together $1 million to go buy their own building, there might be 10 that have 100,000 that want to own, real estate direct, but they don't want to deal with, finding the acquisition, running the due diligence, managing the asset, dealing with property managers, signing on the debt is a big one. And so they're just people that, they might give us 100, 250,000 a year, just so that they can get diversified in real estate without having to go and put all their eggs in one basket, $1 million, and buy a building that, is something they've never done or don't have the skill set to do.
Very, very interesting. I like one thing that you said out there for all the entrepreneurs. Like you said, the majority of their net worth, I believe, is wrapped up in their business.
Yeah.
And, this is a true thing. Like, this is something that you see. And, business fluctuates so much. Like, you can know a guy who's doing $25 million today, and then, something goes sideways, and he might be doing 7 or 8 the next year because things didn't go right. Or, I've known guys doing 15, 20, and then something happens like COVID and they're doing less than one. You know what I
Yeah.
mean? They're just rocked straight to the bottom. And a lot of times you think you think that, in business, you think like it's going to be perfect forever. But the truth is, it's not going to be perfect forever. You're going to have these valleys and you're going to have these low moments, and you're going to have employees that cost you massive deals, and like things are going to go sideways. So I love that you talk to the entrepreneur, because I think if the entrepreneur is out there listening, one of the best things they can do is invest in a group like what you're doing, because you're taking chips off the table. Like you
Yep.
close a big deal or you get a big contract, you get a big win, you take $250,000, you put it into a project like what you've got. You just took that money out of your business, you diversified it, and now that money is out there earning you income. And if something happens to your business, you've got this investment here that you can pull off of, get return off of, right? Like it seems like a smart play to me. How do you see that happening?
Yeah. I'll tell you two stories. One is one of one of the guys that's invested in almost every single deal going back to 2008. He's had, a couple, exits from, tech companies. Not, he's not a billionaire, but definitely, very successful exits. And so he sees it as a way to like take chips out of tech and take them out of the stock market. And so he's invested with us. And, I think that for him, he sees it as like this cash flow thing. And then for me personally, like my goal has always been, how do I get enough cash flow from my real estate investments to pay for my life? And then, once I have that, and I'm, 50 to 60% there, but once you start having kids, everything gets more expensive.
Totally.
And so, once you have that, life becomes really comfortable. The work just becomes, fun. Building a business becomes fun because you kind of have this, whether we distribute monthly or quarterly, you're getting this money that's covering your living cost. And so it just makes it easier to run a business. It makes it easier when things are slow. I think it allows you to take some risks that you can't take when you're depending on the income from your business to pay for your living cost. And so I think that does that answer your question?
Yeah, that does. Yeah.
Yeah.
How much does someone have to invest in deals or multiple deals to get that kind of cash flow?
Yeah, that's a great question. Our minimum is 50,000. Typically we're trying to get to deals that are maybe 5 to 7% cash flow in the first year. What happens with real estate though is, your mortgage, we always do fixed rate mortgage, but your mortgage is fixed. And so as rents go up, that cash flow goes up, generally every year. And so, a deal that, we buy that is 5%, the first year, the goal is that maybe by year 3, 4, 5, we're up to 8%. And so you think about 8%, if somebody gives us, let's say $100,000, now they're going to get $8,000 a year in cash flow. That's not a lot, but if they start giving us, $250,000 or $500,000 a deal, now they have, let's say $1 million at 8% is $80,000. And so you get 3 million in real estate at 8%. Now it's 240. And, for a lot of people that starts covering, maybe replacing their salary.
Right.
I have a cool story as a broker. One of our clients, they had a little duplex. This goes back probably 16, 17 years ago, owned it free and clear. And I think at the time their cash flowing about $3,000. Not super sophisticated. And we kind of went in there and said, look, you could sell that duplex, do a 1031, buy a bigger building and probably double your cash flow. And so they did that. They bought a 7-unit and then their cash flow went to, I think a little bit over $5,000 a year. And then he was an entrepreneur, small business owner up in Finney Ridge in Seattle, and self-proclaimed he never made more than $100,000 a year as a small business owner. But he had this other real estate where his office was in. He sold that when he sold his business, and then he bought a 20-unit. And so at that point, he had a 7-unit, a 20-unit, and probably, maybe $1.7 million or so in equity. We sold that, and he bought a 53-unit after those buildings had gone up. So that $1.7 million, when he bought the 20-unit and 7-unit, turned into a little bit over $3 million. He bought a 50-unit for $9 million, borrowed $6 million. At this point, I think his cash flow, was probably $200,000-$300,000 a year. and then he sold that. This is over 15, 20 years. Sold that and
Sure.
bought 2 more buildings. And so, literally this guy went from like $3,000 a month in cash flow to over $30,000 a month in cash flow by, investing, doing 1031, investing, doing 1031, and almost over 20 years, kind of compounding that cash flow. And so I think that's where it gets super exciting. It's hard to think about putting $3 million into real estate to get 240 in cash flow. But if it's, 500,000 today, and then in, 7 years or 5 years, we sell that deal and your 500 is $1 million. And now you roll it into a deal and it gets 8%, you're doubling your cash flow. And so that's kind of how people, build wealth in real estate. And that's what we witnessed over being brokers for 20 years. And doing that $1 billion in transactions, was watching, all these, investors that do that. And it's kind of a very old school way of building wealth.
Yeah, that's incredible the way you laid that out.
Yeah.
Like, I invest in real estate. I love real estate. I follow the philosophy, that you have of, trying to do a deal a year, do as many deals as you can, right? Like, I love that. But the way that you laid that out was so simplistic. Like, you've got me thinking about my own things. Like, what am I doing here? You know what I mean? Like, why don't I just was, while you were spitting that out, I was thinking about 3 properties. I was like, man, I should just 1031 these. What am I doing? So I really like how you laid that out.
Yeah, as brokers, I think that was what we were really good at, was being super analytical. And maybe we'd have a client, we've done some deals where a client literally sold like 8 properties. We brokered them, sold 8 properties, and then bought one building that was $50 million or $30 million. And so we'd look at it, and a lot of times these owners, they, would buy a property and maybe their goal was to get it free and clear. And they think that they're cash flowing a lot of money because they've owned these properties for 10 or 20 years. But then you do kind of like a return on equity calculation. You say, well, your building's worth this, you owe this, or maybe you owe nothing, and you're actually really only getting 4% cash flow on your money or 3% cash flow on your money sometimes. And you have no leverage, you have no more depreciation. That's the other thing about real estate, is the depreciation, can offset your income. And so we would take those people and take their equity that was getting a 3 or 4% cash flow, 1031 them into larger buildings, use some leverage, and then often double their cash flow through that process kind of overnight. And then also now they get more depreciation. And so their cash flow would be kind of shielded from income taxes. So it's,
You're a smart guy.
It's actually very simple. Just a lot of people don't understand it. And it's scary, right? It's scary to go buy real estate. A lot easier to give your financial planner money and put it in the stock market.
Yeah, I think I'm pretty savvy with real estate. I just feel like I got a school lesson. So this is pretty cool. So you can take multiple properties and you can sell them kind of in a bulk deal, or maybe not in a bulk deal, but one at a time or whatever. And then you can take that money and then you can 1031 all that money into a bigger deal.
Correct. Yeah. There's a lot of logistics. That sounds very simplified, but there's timelines, IRS timelines. But yeah, absolutely, you can do that.
Right. You have like, I don't know what it is. What is it? 6 months to identify the property, make an offer.
Or 45 months to
Something.
identify.
Okay.
Yeah. 45 months
days
to identify. And then, now I'm drawing a blank on the timeline, but I've done this dozens of times. 45 days to identify, and then 135 to close.
So you got to get it done in that period of time. And so
Correct.
Savvy investment. So you got to, really line your deals up. You got to move things the right way. Okay. That's really exciting stuff. You know what? I love what you guys are doing. I think that's pretty cool. One other question, while I've got you on the show, are you guys still doing property management?
Yeah, we are. We manage more properties for other people than for ourselves right now. So definitely still managing properties. That's been a great business too.
Do you do commercial property management?
We do some commercial. Yeah. Depends on location, mostly King County right now.
Okay. Well, not that, this is the podcast show, but let's see. I've got a building in Everett, an office building that I need a property manager for. Okay. I don't know if that's something that you guys are looking in.
We should definitely talk.
Okay. Yeah, that's good. We'll put that on the back burner, but after this call, it would be great. I'll send you the specs on the building and what it is. And, I mean, I would love to have you guys take a look at that for me because,
Cool.
why not? We're on the podcast and,
Yeah.
I don't think we've ever done a real deal on the podcast. So this is kind of a
Well, this will be
cool
the
thing.
first one.
We're doing a deal on the show. We're
We'll
going
get
to
you
get
to
a deal done
1031 some of
on
your
the
deals
show.
too, and buy some bigger properties.
That's right. We're going to I'm going to become a real estate mogul like Mr. Kono. That's
Yeah.
going to be an exciting thing. All right. So we're going to make that happen. So syndication of real estate, like this, the more that you talk about it, the more excited I get about it. Like, I love this idea of investing in something, but not having to sign on the dotted line. I like not having to, like, I don't have the stress of, oh my gosh, I got to give them my tax returns and am I going to get approved for this loan and what's my
Yeah.
down payment going to be? And so what you've done is you've really simplified the buying and the investing process for the person who they just want to get out there and start some diversification. And that is
Correct,
that is a really exciting thing. And it sounds like you've got a lot of investors and you got a lot of growth. What kind of projects are you guys working on today?
Yeah. Good question. We typically right now are kind of targeting acquisitions in the 10 to $20 million range. We think they're big enough to kind of give us scale to manage them well. I think the larger they are, the safer they are for the investors. If you own a single family house and it goes vacant, now you're, 0% occupied. If you own 100 unit or 50, if you own a 50 unit and one unit goes vacant, what is that? 2.5%.
Yeah.
And so, it's just a lot better to buy bigger buildings. I think that 20 million top side, part of the reason of that is the equity that we feel like we can raise. We are looking for larger investors. We'd love to find, an ultra high net worth investor that wants to back us and allow us to go after bigger deals, or an RIA, something like that. But, the nice thing about that under 20 million point is we're not competing with the institutional groups. And so, once you get, 30 million or north, now you start competing with the institutional groups. And so it kind of gets more competitive. So I think that, under that 10 million is competitive because you have a lot of smaller new investors. Over 30 million gets competitive because you have the institutional investors, and, 10 to 20 and then really 10 to 30, I think is a little bit less competitive. There's still competition, don't get me wrong. But it's just, a really good price point for the size of buildings you're buying. We're kind of trying to buy 80s vintage and newer. Historically, we've always bought in Washington, but we are looking, out of state, some states where, it's a little more landlord friendly. A lot of people probably know that they recently passed, a form of rent control in Washington state. And so for a lot of these reasons, we're looking to buy, in some other states. We like Utah, we like Texas, we like Idaho. We've been having multiple meetings with another group that has been doing this for investing for 20 years, that they're trying to kind of slow down. And they own a lot of buildings in the Southeast. They had 3,000 units in the Southeast at one point. And so we've been talking about partnering with them. And they're local guys, but they just kind of chose to invest in the Southeast. And so we're, definitely buying out of state will be in our future. And for me, that's also part of the diversification. So, I think right now I'm in, 14 or 15 deals, and they're mostly in Washington state. And so, for me, it's kind of diversifying some of my real estate holdings outside of the state. And so a lot of the investments we make are, kind of driven based off of my, I guess, personal investment philosophy and how I want to invest my money, because we're putting money in all the deals that we do.
Very cool. I like that idea of investing outside of Washington state. I think that's a phenomenal program and idea. I'm not familiar with this rent control thing in Washington. What is that?
Yeah, well, it just passed. I think the governor signed it this week, maybe. It was in the state legislature, this last session. Yeah, and so, it's not great just because it's, regulation, but it's also not horrible. So you can now raise rents the lesser of 7% plus CPI or 10%. So 10% is still a pretty healthy amount. I don't think that's too restrictive yet. The sad thing is the people that are going to be hurt the most are these owners that, there's a lot of owners, the ones that own the building for 30 years, and maybe their tenants have been there for a decade, and they never raise the rent because they like their tenant. They want to reward their tenant. They don't want turnover. And now maybe the market rent on that unit is $2,000 and the tenant's paying $1,200. And so now that owner that has been, a landlord that wanted to kind of keep rents lower for their tenants is being penalized because, the market rate is 2,000, that tenant's at 1,200, 10% a year. It's going to take a long time for them to catch up with market because the market's going to keep moving. And so those people, I think probably lost millions of dollars of value on those buildings where the rents are below market.
Wow.
Which is super unfortunate.
Wow. So let me ask you this question. Might be a silly question, but if you go in and you've got that tenant, they should be paying $2,000. They're paying $1,200. Let's say they move out.
Yep.
If they move out, can I bring that to $2,000 or am I?
You can. Yep, you can.
Okay. So you do have some room there, and it kind of feels like the rent control, that almost creates like it feels like almost it can create a slumlord type situation where you just, you're not being like, if you were that landlord and your rents are at $1,200 but everything else is $2,000 and you're trying to be good to some people who've been there for a while, like the cost of repairs, the cost of roofing, the cost of siding, these things are going to continue to go up, but you're not going to now have the capital to make those necessary infrastructure repairs. So the quality of the building is actually going to be, in reverse, right? Like it's going to be going backwards.
I agree 100%. I mean, it kind of, handcuffs the owners on being able to invest in their buildings. Number one, you look at insurance. Insurance has gone up double digit a year the last probably 5 years. Taxes have gone up, utilities are going up. As you know, cost of labor, maintenance, all those things are going up, really at sometimes more than 10%. And so even though CPI maybe goes up 3%, the cost of insurance goes up 15%, cost of roofs goes up 15%, that sort of thing. And so it definitely becomes, more challenging with this rent control, particularly on the older buildings. I think, we like to now, that's part of why we like to buy these 90s or newer. So we're not getting, galvanized plumbing. We're not getting old electrical panels because you get that stuff and you got to replumb a building. That doesn't mean you can charge more rent. It just means that you spent, 6 figures of CapEx to get zero return because you had an old building. And so I do think those buildings are going to fall more into disrepair, unfortunately. And it's kind of crazy. There's not one study that says that rent control works to keep housing more affordable, but politicians, pass it in certain states and cities. So it's unfortunate.
Yeah, it's it is unfortunate, and this isn't a political show. Otherwise, I'd have a whole opinion about it. But at the end of the day, I think it's bad, and I don't agree with more controls and more regulations, and I think that stuff's tough on anybody in business. But since we're kind of on the topic, how would you describe the impact of tariffs and recession? Talk on the current market for apartment investing.
Sure. Yeah. I think that we're probably at the front edge of seeing the impact of tariffs. It'll be interesting to see how long the tariffs hold, but I think that, it's going to start impacting everything. Most of these things that we put into these apartment units, whether it's new construction or renovations, a lot of it comes from China, whether it's, the stone counters, the flooring, the appliances, drywall. I think I read a stat, like 70% of it comes from Mexico. Lumber, I think, a huge percentage of it, you might know, comes from Canada. And so, overall, I think it's not going to be good on the cost of, new development or ownership. And so, really, I think it's going to make housing more expensive. What's kind of happened since like the middle of 2022 and even before 2022. So, when interest rates, going back to 2018 and through COVID were, very low, that allowed a lot of developers to build a lot of product. And so we had kind of like starting in 22, 23, 24, and this year we kind of had like a 40-year high of new apartment deliveries. And so what happened was we had all this delivery of apartments at the same time that interest rates, borrowing costs for apartments went from like 3 to 3.5%. Now they're kind of in the 5.5 to 6.5% range, and they were even higher for a short period, kind of at the end of 22 and early 23. And so you had all these new projects coming online. The rental markets softened. Rents went down in a lot of markets, and then at the same time, borrowing costs went up. And so what happened was bunch of products got finished, but the pipeline for new product has basically dried up. And so I think that the tariffs are going to make it worse, because now the construction cost is even higher. You got higher construction cost from the inflation we had. If we have tariffs, it's going to get even higher. Borrowing costs is greater. And so really, I think what the industry thinks is that, we're not going to see, and they know because it takes 2 years to build an apartment building, we're not going to see a lot of delivery in 26, 27, 28 of new apartments, but we still have a shortage of housing, depending on the stat, 4 to 6 million housing units in the country. And so I think the impact is that, rents are going to go up. They're probably going to go up at a greater rate than, the historical 3-4%. We're kind of modeling 3 to 5% a year when we look at buildings, but I honestly feel like, you take a market like Seattle, I could see rents going up, 7, 8, 10%, for a couple of years in a row, because there's just not any new product coming online. That's happening in markets across the country. So it'll be good. I mean, it's been tough 3-4 years to be an apartment owner in the Puget Sound. But I think we're, on the bottom of a cycle and kind of the start of the next upside, which is, one of the reasons that I took the opportunity to go full time on the investing side.
Wow. That's very cool. And are the majority of your deals multifamily?
70% of them are. We did get into some manufactured housing communities, I guess 50% of multifamily. So we got into some manufactured housing communities, and then we got into, from there, that kind of got us into RV resorts, which is more of a hospitality play. So yeah, but we're right now we're very focused on the multifamily. When the yields got very compressed on those, kind of 2019, 2020, 2021 was when we, focused a little bit more of our attention to the manufactured housing communities because the yields were better. But we just think it's really a prime time. This reminds me of like how 2009, 2010, 2011 was. And if you had bought buildings during those years where, there was kind of fear, we were in the middle of, the recession. You go to like 2017 and any property that was bought in 9, 10 or 11, you're like, man, I wish I would have bought more. And so I think we're kind of at that point where, if we go out to 2030 or 2031, people are going to say, I really wish I would have bought more in 2025, 2026.
Incredible, man. I love listening to you talk. You just got it going on.
Yeah.
Maybe
I should get my own podcast.
You should, man. You should just get out there and just.
I just don't know what to call it. And, there's so many podcasts. I was like, well, I don't cold plunge. Maybe I'll make it a podcast about how to have success without cold plunging. Because everybody that's successful cold plunges now, right? So if you have any guests that don't cold plunge that are successful, they could be on my show.
That's awesome. I haven't taken the full cold plunge, but I will tell you that I'll take an ice bath every once in a while.
Yeah. After your runs, I bet.
Yeah, after the runs. After the runs.
How many marathons have you done now?
This is I've done 7 in the last 12 months. I've done 5 in a row. Next weekend I run in the East Coast. And I got another one coming up, and I'll tell you that my body's getting sore. Like in the I mean, I'm only halfway through, so I'm only halfway through my goal, so I better get organized. But I was actually just thinking about it this morning, and I was thinking to myself, I do training runs during the week, and I was like, I'm going to start limiting my training runs Monday through Friday to 30 minutes. I'm going to take a little pressure off the knees. I'm going to take a little pressure off the feet. And, I don't know, man. I'm an entrepreneur, and I love flashy things. Just, I don't know why. I'm addicted to things that are just kind of, I like nice things. I don't know why. Maybe it's because I grew up super poor, never had them. I don't know. But I like nice shoes, I like shoes and stuff like that. So like, I love to get a pair of Louis Vuitton shoes every so often, or, something like that, whatever. But I'll tell you what, as I've taken on running, I love cowboy boots, right? Because I'm from Texas. I, like to think of myself as a cowboy. I've got probably 50 pairs of cowboy boots. I can't wear any of them. I can't put them on my feet because I run so much that my feet and ankles, they hurt so bad. And if I put those shoes on, like I may not be able to do the next 10-mile training run because of the pain, right? So
wow.
What I find myself doing is wearing Hokas, okay? And there's nothing wrong with the Hoka, and I know that millions of people love Hokas, but man, Hokas are not my style, and I don't mind rocking them. I don't mind wearing them. I'm not dissing to anybody wearing the Hoka, because I have like 5 pairs of them that I rotate through, so I don't look like I'm wearing the same shoe every day. But I mean, if I'm not wearing Hokas or something like that, or On Clouds, or something like that, man, I'm not running. I'm not getting it done. So I'm in this stage of just, okay, taking care of my body. And after a big run like I just did in Houston, and then having another run coming up so soon, like my times are up a couple of minutes a mile right now. And I feel like I'm pushing as hard as I was, but I know that it's the recovery in my body, right? So got to get recovered, got to get, it's just something that you work through. So I'm going to, see how this run goes, and, God willing, we're going to push through it, and it's going to be exciting. And I'm only halfway through the year, so I got a long way to go. So, just you pace yourself, right?
Yeah.
It's kind of like in real estate.
Incredible you're doing them, and I watched you do that first one, and I've never in my life considered myself a runner, and my guess is you probably can relate. And here you are doing 7 marathons, and I think it's just incredible, mental feat, and kudos to you.
The first one almost killed me.
I think it would kill me. You're braver than I am.
I started these at 335 pounds.
Oh.
Right. I just got under 300. So if, I like to tell the guys that, got muscles bulging out of every part of their body, and they just look perfectly beautiful out there running. I like to say, what this is like is you running with me. When I'm running, it's like you running with me on your back. How many miles are you going to get?
Yeah.
Am I going to slow you down a little bit? But man, I really love what you guys have put together. I love the investment tool. So I think that any listener out there, they'd be foolish not to have a call with Pilot Capital, not to get involved. Like, so many people want to get involved in real estate. What you guys are doing is just incredible for the buyer, for the just the business health. Like, business is so hard, and the SBA statistics tell us 2 things that are really important. Is at 15 years, 75% of businesses are gone.
Wow.
And I think that, and some of that's acquisition and some of that's sale, but a lot of that is failure and quit and I'm done, right? And at 25 years, only 1% of businesses have survived.
Wow.
And that's an even bigger drop off. So you think about the time you've been in business, the time you've been there, and you look at, your entrepreneurial journey. And if you're starting out 28, 35, 40, the chances that you are running a business in 25 years are 1%. Right? 99% of these business owners will be gone.
Yep.
And you're going to have these incredible years in your business. You're going to have years in your business that are just man, you made so much money, you never thought you were gonna, you never thought anything bad could happen. And you're going to get fat and lazy and things are going to happen and it's going to go sideways and you're going to have those years where you're literally ripping your hair out and you just want to die. And I'll tell you that that's the entrepreneurial journey. And so for that entrepreneur who's out there, the number one thing they can do is get with you. Like, invest in that real estate. You know, if I put $1 million into your business at, 5% return, I make $50,000 a year, basically minimum return. High end return, I'm going to make $80,000 a year in cash flow. If stuff hits the fan, like, I can live off of $50,000 a year. It might not be the greatest living in the world, but you can do it.
For sure.
And that's the thing, is that sometimes when business dries up, it's done. You don't get it. And that $50,000, that $4,000 a month or whatever it is, $15,000 a quarter, whatever it is, like, that money starts to come back. But I'm also guessing that you're not holding these properties for decades. Like, you've got a cycle of flip. And I'm imagining when that flips, there's also a cash event that
Correct.
is a huge benefit to an investor, right?
Yeah. So typically when we're underwriting deals, we're trying to double our investors' money in 5 to 7 years. And so I would say, early on it was like 5 years. As real estate got really popular, mid-teens, 2015 to, really the last 2015 to 2022, yields went down. And so then it was like, well, can we double their money in 7 years? I think we're getting back, because now there's more competition. We're getting back to the point where, can we, get to 5 years doubling people's money. And so when you think about that, let's say it's $1 million and it's 5%, then maybe it gets to 7%, but then you double that and it turns to 2 million. And then now you get 5% on 2 million, and that goes to 7% on 2 million. Now all of a sudden that's, at a certain point, 140,000 in cash flow from that $1 million investment that you made, 10 years before. But yeah, I think that, when you talk about businesses not succeeding, sometimes it's just burnout, but sometimes it's disruption. And so I think a lot of our tech guys, they like it because, the tech guys know, like, the business I start this year in 2025, it may be obsolete in 2035. And so, housing though is not going to become obsolete, and as far as I can tell, I don't think that housing is going to get disrupted by, AI or technology, but a lot of things are going to be disrupted, and have been disrupted by technology, and advancements. But, housing, there's software for property management and, different software tech stacks for everything around real estate. But the fundamental thing of housing, just like food, is going to be there.
I love it. Anybody in the audience, how do they get a hold of your firm?
Yeah, so our website is pilotcre.com. So that stands for Pilot Commercial Real Estate. So pilotcre.com. I'm on LinkedIn. I've been trying to follow your lead and be a lot more active on LinkedIn. So just look me up. Jason Kono, Kono, is probably the best way to reach out to me. And love to talk to anybody. We love talking.
Get him out there.
So it's exciting.
Get him out there. Follow him. Get out there. This guy's doing it. These are the guys to connect with. I love it. And I love that we're going to make some deals happen here too. So that's exciting. Good. And listen, follow him on LinkedIn. I'm your host, Dave Westcott. Follow me on LinkedIn, Facebook, Instagram, anywhere it's social. I'm hanging out 9:15 a.m. Pacific Standard Time every Tuesday. We are crushing it with incredible guys and gals like Jason Kono. Thank you very much for your time this morning.
I appreciate it. That was awesome. Thanks, Dave.
You're welcome.
We'll talk soon.
Mike Bott from Frost Solutions, one of the owners of the company. What we do is provide a mini weather station to give you a tailored forecast to those particular locations, so you know where and when and what to do in those parts of town. There's 2 or 3 or 4 or 5 different ways that people can experience tremendous value having a technology like this.
Introducing the all-new Western Enforcer V-Plow. Engineered with all the features, efficiency, and performance of full-size Western V-Plows, built specifically for your half-ton truck. For more information, visit westernplows.com.